Hey, welcome back to the series of Accountancy Chapter 3 Admission of a Partner. In this video, we are solving a second problem regarding 12 marks. So, we'll start with analyzing problem. A and B are the partners in the firm sharing profit and loss in the ratio of 6:4. So, this profit and loss will be sharing on based on the 6:4 ratio. The balance sheet as on 31st 2017. Next, they're given actual balance sheet. So in the balance sheet, liability side we have creditors 20,000, bills payable 6,000, reserve fund 4,000, and capital 40 and 30. Next, in the asset side we have cash in hand 5,000, debitors 20, less provision for doubtful debts 22,000. Okay, 2,000, and that makes 18,000. So next, stock 17,000, building 30,000, furniture 30,000. So again, a simple balance sheet, nothing complicated here. Next, we have adjustments. On 1/4/2017, C admitted in the partnership business. So he's bringing 25,000 as capital and 8,000 as a goodwill towards the partnership. Next, 1/6 share. Okay, 1/6 share in the future profit. They are agreed to share the 1/6 share. Next, we have a depreciation on the furniture, or depreciate furniture at 10% and appreciate building at 20%. So this will be reducing the furniture value by 10% and 20% the building that will be increasing in the building. So next we have provision for doubtful debts. So this is quite not tricky, quite advanced, a little bit advanced. I may put up like this. It's quite twisted. So provision of doubtful debts is no longer. What is no longer? No longer means it not going to exist. So that means here they did not mention what is the amount, but in the balance sheet they did mention the 2,000 rupees as a provision for doubtful debts. So this 2,000 already less or minused in the last year balance sheet, but this will be no longer considered. So that means you need to add this. You need to add. I'll show you a way to add right now. Just remember that. Next, provide 1,000 rupees for repair charges. So repair charges will be 1,000 rupees. Next, goodwill is to be withdrawn by old partner. So this is the first sum we are solving based on the goodwill withdraw. In the last problem, we did not mention about withdrawing goodwill because on that situation we used to assume that there is no goodwill withdraw. So here they clearly mention to withdraw the goodwill, so that will be affecting in partners capital account. So this is a problem. We'll solve it. First of all, we need to prepare revaluation account. So as usual, revaluation account heading, debtors, debit side, credit side. Next, particular amount. I think after you set up everything, get back to adjustment. In the adjustment, the first adjustment is for the second account, that is partners capital account. So this is not right time to go for this adjustment. We'll check the second adjustment, depreciation for the furniture 10%, or depreciate, you must depreciate 10% furniture, then building 20%, that should be appreciated. So building will be appreciated by 20% and furniture will be reduced by 10%. So we'll first at building, that should be increased. Right, by building, total 30,000 is an amount and 20%, so 20 divided by 100, that will become 6,000 rupees. Next we have furniture. Furniture is depreciating. So in the last video I do mention about a trick. The trick is like, if anything is adding or anything is bringing value or like increasing stuff, you need to mention in credit side like asset or something, and whatever the liabilities or which should affect or which should create minus for the company, that will be written in the debit side. So that's it. Here furniture is getting depreciated, so the value is getting down. So we'll write in the debit side 30,000 to furniture, 30,000 divided by 10 or 10 divided by 100, that will become 3,000 rupees. That's it. So get back to again the next point. Provision for doubtful debts is no longer considered. Here they are considered, or here they subtracted out of 20,000, they subtracted 2,000 and that has become 18,000, but this is no longer considered. That means probably that is getting back to the business. So we need to add it. Like last year we subtracted. That's why we are adding this year. So by provision for doubtful debts, add the 2000 because we are no longer considering it. And get back to again the next point. Provide 1000 rupees for repair charges. Repair is an expenses. So we need to write in the debit side. Write to provision for repair or to it's not provision, it's to provide for the repair charges 1000 rupees. Don't mind this provision. And get back to adjustment, check whether we have any left out. We cleared depreciation, provision, and the repair charges as well, and this is belong to the partner's capital account. So we cleared everything in this, so that's it. We'll be totaling it. Check whether we have more in the credit or debit side. We have more in the credit side obviously because we have 6000 and 2000, but here we have 3000 and 1000. So if you add this it will become 8000, and that should be written here as well. Then if you subtract 8000 from these two items, you will get 4000 rupees. So the last step is to transfer this to the partner. So what is the ratio they used to transfer the old profit sharing ratio? That is given in the starting itself, that is 6:4. So based on that we need to split profit to profit transfer to, right? Then A, write 4000 rupees into 6 by 10 and 4000 rupees 4 by 10. That's what, right? 6 plus 4, 10. So 10 is to 10. 6 by 10, 4 by 10. That's it. So if you divide based on this, now to make easy, cancel this 0 and this 0. So 400 into 6, 2400, and cancel again the 1010. So now it will become 400 into 4, 1600. So that's 8. We got a profit of 4000 and we even splitted it. That will be affecting, or that will be used in, like these two amount will be used in the next account. So moving on to the next account, that is partners capital account. Here we need to be more caution because some entries are missed out in the last video, and this time we also have another addition, that is we need to withdraw the goodwill. So here some are the new entries will be coming, and in the last video we solved it based on the previous problem. It's not as per the accounting standard 26, but this problem is as per accounting standard 26. So we'll solve it as per the accounting standard. First of all, we need to start with the balance brought on. The balance brought on is nothing but the amount they are bringing to the business, that is 40,000 and 30,000 capital. So write by balance brought down 40,000 and 30,000. Next, we need to write revaluation account profit. Like A is getting 2,400, B is getting 1,600. So write by revaluation account 2,400 A and B 1,600. Next, we need to write reserve fund. That should be added to the capital, so that's why we're writing it. So we have 4,000 and that should be splitted based on the 6:4 ratio. So write by reserve 4,000, and 4,000 will be splitted into like 6 divided by 10, and in the same way we are splitting for the B into 4 divided by 10. So if you split like this, you will get 2,400 and 1,600. So you need to share according to the old ratio. Next, we need to pass this entry. So the C is bringing 25,000 as a capital and 8,000 as a goodwill in the form of cash, or we'll consider as a cash. Nothing is said here. Buy cash under bracket, in the bracket write capital, write 25,000, and that's a new capital brought by the C. Okay, capital of C, you can write capital of C. So next, this is for capital, and next we have to write for the goodwill. So write by cash, write in the bracket goodwill. This is all as per the accounting standard 26. So write 8,000 rupees as a cash. He's bringing 25,000 as well as 8,000, and this 8,000 is not belong to C. 25,000 is his capital 8,000 is not belong to C. That should be withdrawn by the old partner, and first of all we need to transfer it. Then the partner will withdraw this amount. So here you are written in the credit side, and that should be debited because here is bringing the amount, and that should be taken off from his capital. Right now it's in his capital account. That should be take off by A and B. So I'll tell you one by one. First of all, write by cash goodwill 8,000 rupees. After that, that 8,000 should be transferred to two partners, that is A and B, based on the ratio 6:4. So write 8,000 by goodwill account, 8,000 rupees into 6 by 10, and 8,000 rupees 4 by 10. So based on that, if you calculate single zero and this single zero cancel, 800 into 6, 4,800, and 800 into 4, 3,200. So right now what you did is you just splitted the amount for A and B, and that should be withdrawn by the old partners, right? In the debit side they are withdrawing this amount, this deposited amount is withdrawn by the old partners. So again they'll withdraw the same amount, 4,800, 3,800. No need to calculate, just write to cash account withdraw 4,800 and 3,200. Here C is not withdrawing any amount. Next, if you are not debiting this amount 8,000, this will become 33,000 as a capital for the C. So not to avoid that, we need to take off this 8,000. So that's what we are writing here to A's capital account. How much he has to pay for the A's capital account? What he just paid, that's it, 4,800. And in the same way, C has to send, or C has to be debited in order to send B. So that should be debited in the name of C to B's capital. He's sending 3,200. Here's what he sent. So that's it. Now the answer will be same as per compared to the old problem style, but the two entries are this: by cash goodwill, this, and this entry will be added in accounting standard 26. Again the answer will be same. You're just adding 8,000 here, and you're just taking off the 8,000, and the same amount will be there. There's no change in the amount. So what is this making? He's giving 8,000 in the form of cash. That will be considered as a capital, but this capital is not belong to C. That should be credited or transferred to A and B, and again this 8,000 will be taken off from C's capital account. So here we added two account. If you just left it right away, if you're not doing this step, the second step, I'll call this first step and this is the second step. Okay, if you are doing the first step and if you are skipping the second step, that will change the amount, because here 8,000 will become 33,000 and this amount will vary. If you add here and if you take off that again 8,000, that doesn't make any difference, but in this capital account you'll get full marks. So that's it. This is the difference as per the accounting standard 26. Next we need to create balance carried on. So what is the balance carried on? I know this is a very mess. I'll erase this because it's kind of mess right now. Okay, next total it off. If you total this, again we have a credit side. It's always credit side is more. You can't spend more than that. 40,000, 2,400, 2,400 and 4,800. That will make 49,600. Okay, next for B, 30,000, 1,600, 1,600, 3,200, 36,400. Okay, next 25,000 plus 8,000, that will make 33,000. Now you need to subtract the debit side amount. So A is withdrawing 4,800 and B is withdrawing 3,200, the goodwill. So just subtract 49,600 minus 4,800, that will make 4,800, 44,800, and again same here. If you subtract 36,400 with 3,200, that will make 33,200. Again subtract 33,000 minus 4,800 minus 3,200. Again the capital will be same, 25,000. So that's it for this. These are the amount we require to enter in balance sheet. Okay, we are coming to the last part, that is balance sheet. So the balance sheet is like this. We'll start from the last year balance sheet. We'll take reference from the last year balance sheet. So first we have cash in hand 5,000. So we'll write that as it is cash in hand, but we have only 5,000 plus this year C is bringing 25,000 capital plus C is bringing goodwill. This is goodwill. uh, it's a goodwill bought down, and this is goodwill is withdrawn here. This 8,000 is form of broughting down the goodwill, and this 8,000 is taking off or withdrawing the goodwill. So 8,000 get cancelled, plus 8,000 minus 8,000, and we have 25,000 plus 5,000 30,000. That's our amount. Next we have debitors 20,000. There is no change because we don't have anything. We already added that. Nothing is to be written here. Next we have stock 17,000. So again the stock will be the same, nothing special there. So next building is appreciated 20%. So the appreciation amount is 6,000 rupees. You need to add the appreciation amount for the building. So the building amount is 30,000, and building 30,000 add appreciation, that is 6,000. So that will become 36,000. Next furniture is depreciated by 10%. That means 3,000 rupees, right? Here we wrote the 3,000 depreciation amount. So this should be subtracted in balance sheet, right? Furniture 30,000 less depreciation minus 3,000, that will make 27,000. So asset side is over right now, and we'll move on to the liabilities side. Creditors 20,000, the same amount. Creditors 20,000, nothing is changed here. Next bill payable, again same amount. Bills payable 6,000. Reserve fund we already added for the partners capital account, so this should not be considered. Next we have capital. So we do have capital, but this not the amount we are recording. So let's record A and B and including C's capital here. So A, B, C, write capital A, B, C. We need to write capital. You can find this capital in partners capital account, that is 44,800, 33,200, 25,500. So write 44,800, 33,200, 25. So these are the capital. Next, come back to the adjustment. We have entered this 2 times, and this is also again considered double time. This is not important because there is no longer of doubtful debts. So next we have this one, repair charges. We only entered 1 time, so we need to enter twice. That's what we are entering right now. Provision or provide for the repair charges 1,000 rupees. That's it. We cleared 99% of this sum. The last 1% is to tally the sum. 30, 20, 17, 36, 27 will become 1,30,000, and again 26,000, 44, 800. Again the all amount will be coming like 1,000, 1,30,000. So that's it. This is how you need to solve this problem as per the accounting standard. So thank you for watching. See you in the next series. Bye.